Hey there everyone, how you doing? So this week, some very important news out of the United States as we had the two-day FOMC meeting finalized and US Fed Chairman Jerome Powell announced to the world an official cut to US interest rates of 25 basis points. The market had obviously baked in this cut of 25 points for many months. That wasn't really the big story to take away. It was more about what Powell said gave him the impetus to make the cut. Now, if you're a perma bull or a perma bear when it comes to the US economy, well, Jerome Powell gave both camps a little bit. So let's break it down. For the bulls, Jerome Powell mentioned an increase in US consumer spending. Now, the US is the world's biggest consumer economy. It loves to hear that its citizens are spending money, so that's good. He also mentioned that inflation was staying within the US Fed's recommended band. So that was a little bit of extra good news, along with the numbers for second quarter GDP growth, apparently coming in at 3.3%. So all this for the US is good news. And according to the Fed, justification not just for the rate cut a few days ago, but also the unwinding of its restrictive policy when it comes to credit creation. It wants an easing policy for interest rates moving forward. Now, of course, as I said, the bears also get something out of this as well. Yes, inflation is within the recommended band for the Fed. However, it is sticky inflation. So that means it isn't transitory. It isn't just going to be a case of supply and demand. No, this inflation is going to hang around for a while. And in fact, it does appear tariffs are directly contributing to certain goods and services seeing increased inflation. So that's a worry. But the big news was US employment. Not only do we have a drop in US participation rates in the economy, but overall unemployment is also rising. So that is all bad. Now, it just so happens between the good and the bad news, something else transpired this week. And it was this. Priced in US dollars, gold broke $3,700 an ounce, a new all-time high. Now, to me, that's very telling because that is a signal from the market about what its take is on what Powell's doing. And so you may be wondering, some good news for the US, some bad, interest rate cuts and gold rising. What's it all mean? It's in the newsletter. And below the description box there, you'll see, read the blog here, click read and enjoy. Comments or thoughts that this may garner, please put them in the comments. Always like reading them. And while you're there, hey, like, subscribe, what all the cool kids do. In the newsletter, I lay out a scenario that sees the gold price moving much higher than where it is now. And remember, it's at all-time highs now. Because below the rhetoric of the US federal chairman, there's some nuance that you need to apply to the figures. For instance, US consumer spending is increasing? Well, that's true. But get this, it appears it is the top 10% of all US wage earners who are accounting for 50% of that rise in consumer spending. We also had good news about US second quarter GDP. Well, again, that's more nuanced than that because approximately 1.1% of the 2025 year-to-date GDP growth is directly attributable to artificial intelligence related spending and investment. I'll put it to you bluntly. When you have an economy where the true drivers of growth are so incredibly concentrated in only one or two specific sectors, that is not a healthy economy. And I don't care what Trump or the US Fed chairman has to say about that matter. And so as you'll read in the newsletter, I give my thoughts about just why today could be a fantastic setup for you to ride a much, much higher gold price between now and the peak of the real estate cycle, and perhaps even beyond it. All right, well, thank you for your time. I hope you get something out of the newsletter. I'm sure it will generate some thoughts and get the wheels spinning because there's a lot involved in it. But unfortunately, being so close to the real estate cycle peak, we really do have to take the time and nitpick and pull apart the things that central bankers say to us, because not all that glitters is gold, is it? Alrighty, well, I wish you farewell, good luck. See you all here again next week.